Announced this restructure and change to their executive leadership team. What have you made of the news? And I suppose just your general thoughts on the stock.
If we have a look at Fairfax, it is moving towards this digitalised platform, and today's move is another step in that direction. So trying to streamline its business units. And I think there's really two keys to this stock. One, that they managed to monetize their content, and number two, the cost control part of it. And if we have a look at both these sides, they've been moving quite aggressively in both these areas. We've seen changes to the paywall. In fact, for international readers now, they have to pay $15 a month to be able to access content. And for domestic local readers, there will be changes coming in around about mid-2013, mid this year, where we will see the type of metered plan that we've seen with the New York Times, which has been seen to be quite successful. So if we have a look at Fairfax's share price, this is just over the last 52 weeks, so this is over the last year. You can see the shares have been doing quite well. They bottomed out in around about October at the 37 cents, and they've been rising steadily ever since, and we're seeing it above the 60-cent mark. I think really what investors and traders need to see now is that the changes that they have made are starting to flow through down at least to the top line, so the revenue line. We know that things are still pretty tough out there, but the share price has now rallied quite high, and those two keys, being able to monetize content as well as the cost control part, we now want to see some results coming through because the share price has now rallied quite high. So if you're investing in Fairfax, you're investing in a turnaround story. We know that they're trying to deal with the structural challenges, and hopefully the cyclical challenges are starting to improve. So with Fairfax today, some more changes coming through, but it's going to be a pretty hard day for most stocks today.
Looking to sell stakes in their coal assets here in Australia. Coal and Allied, a 29% stake, is one that had been rumoured about the market. Rio Tinto saying they're refusing to comment at the moment. But smoke where there's fire. Fire where there's smoke, I should say.
Well, if we have a look at the moves by the big miners, we know that they have been delaying projects or selling off stakes in some of their non-core assets. If we have a look at Coal and Allied, it is a subsidiary of Rio Tinto. Rio Tinto is a major shareholder there. So I guess speculation as commodity prices drop and we continue to see weakness in these prices, that we are going to see those commodity players knuckle down. So really watching the big players like BHP, Rio Tinto, to see how they manage the current environment. It does look like a lot of short-term weakness for the time being. China's on holidays actually today and tomorrow, so we're not going to see much out of those two markets today, but a key driver has been that growth out of China. So we're still watching China to give us a lead into how our commodity players may be doing, but we know that in terms of coal, it's been a very difficult area to be in because of the slide that we've seen in prices. And in terms of the iron ore, well, we know a lot of supplies coming online from BHP, Rio Tinto, as well as Fortescue in that Pilbara.
Big miners, I mean, would you take a contrarian view? Do you think that they're looking attractive at these levels?
I think the thing to consider is at the moment what we have seen is a lot of projects now on hold, and it does take a long time to get a mine up and running, so you're looking at 3 to 5 years. So at the moment, while we are seeing a lot of supply in the marketplace in terms of iron ore and in terms of copper, and that's really helping to keep down prices, what you're going to see in 3, 4, 5 years' time is that if China continues to see strong growth rates, that you're not going to see a lot of these new mines coming online with supply, and you'll probably see the dynamic shifting in the other direction. So if you're looking at a medium to long-term view, then if you believe that China is going to continue to industrialize and grow strongly, well, at the moment we are seeing a bit of a rut because there is a lot of supply in the marketplace. We are seeing some costs rising, but 3 to 4 years down the track, when we don't see a lot of these large projects coming online and starting to produce, then we could see the dynamic shifting the other way, and that could be quite an attractive proposition. So we are seeing a bit of short-term weakness in terms of commodity prices, but as long as China continues to industrialise, we could see a shift in the next 3 to 4 years, and that might be very attractive. In terms of the big miners, probably more of a Rio Tinto story rather than a BHP story because of its exposure to petroleum. But altogether, at the moment, are not looking good today on the market, but 3 to 5 years down the track, we could see the dynamic shifting quite substantially.
And Julia, was that the general sentiment? You at the Mines and Money conference a couple of weeks ago or so in Hong Kong, and was there general optimism over that outlook for the sector?
Well, with the Mines and Money conference, there were a lot of the smaller mid-cap miners out there, and it is quite a difficult environment for them. It's okay for the miners which are producing and that don't have a lot of debt, but for some of the explorers which are looking to raise capital, it's quite difficult out there on the market. There was a lot of talk about the disconnect that we're seeing between gold stocks versus the gold price, And I guess one of the things that we don't focus too much on is that while we have seen the gold price increasing, the gold miners haven't increased as much. And that's really because we've seen the cost side of the equation increasing quite substantially. Over the last couple of years, we've seen cost rises in terms of production of between 10 to 15%. So you're seeing these operating costs rising and really eating into profitability. It's interesting to see some of the gold companies over in the US choosing to pay a dividend to shareholders, and not only that, choosing to pay a dividend in either cash or in gold coins. So that was an interesting development. But I guess investors in these mining companies now want a bigger share of the profit. So the real emphasis being on profitability in terms of paying dividends, and also in terms of cost control, because we have seen some pretty big cost blowouts coming through. But because a lot of supply now has been, in terms of new mines coming online, has been curtailed, we could start to see an uptick in the next 3 to 4